Herbertson, and I'm the Technical Director for Climate and Energy here at IPECA. Before we start, I would like to cover a few housekeeping items. The webinar is being streamed to your computer, so there is no dial-in number. Everything you can see, including the slides, is resizable and removable, so feel free to move things around and get the most out of your screen. At the bottom of your screen, you will see some features that are available. You can use the Q&A box to ask questions as we go. Please indicate who you would like to answer the question, either an individual panelist or the whole panel. The slides are available in the resource list if you would like to download them. Also, there is a help feature. Most issues can be sorted by refreshing the page using the F5 key. This is particularly useful if you think your slides are falling behind. The recording will be available later this week and can be accessed using the same link you are using now. And now I'd like to say a few words about IPECA for those of you who are not familiar with the organization. IPECA was formed in 1974 following the launch of UNEP, the United Nations Environment Programme. We are the only global association for both the upstream and downstream oil and gas industry. Our membership operates worldwide, and we reach about 500 oil and gas companies when we include the reach of our association members. Our work encompasses four broad themes: climate, environment, social responsibility, and oil spill preparedness and response. We are the industry's principal channel of communication with the UN and work closely with a number of UN bodies. We present side events at the UNFCCC, the Conference of the Parties, and at the UN Convention on Biological Diversity, at the UN Environment Assembly, and the UN Business on Human Rights. One of our recent activities has been to map the oil and gas sector to all 17 of the UN Sustainable Development Goals via our SDG Atlas. This in conjunction with the UN Development Programme and the World Bank IFC. And we are currently working with the World Business Council on Sustainable Development on an oil and gas sector roadmap for the SDGs. IPECA is not an advocacy organisation. We are member-led and we concentrate on technical and fact-based information. We use our convening power to bring together professionals from our member companies to work together to develop and share good practice. This enables the industry to improve its environmental and social performance. We also look to enhance and share knowledge on topics of interest with members and external stakeholders, hence this joint webinar today. I would now like to hand over to Camilla to introduce IOGP, who is jointly hosting this webinar. Over to you, Camilla.
Yeah, good morning, good afternoon from wherever you are dialing in. So IOGP stands for the International Association of Oil and Gas Producers, and IOGP is the voice of the global upstream industry. Similarly to IPECA, we were also established in the 70s. We have 3 offices. My colleagues in London, they cover a number of technical issues, safety standards. We also have one colleague who is working in the US, and me personally, I'm based here in Brussels. Together with a number of colleagues, we are covering the EU policies like climate, energy, air quality, and of course, sustainable finance, which is getting more and more attention. In addition to this, we are providing expertise and information to EU policymakers on technologies such as CCS and hydrogen and how this fit into the achievement of the Paris Agreement goals. So without further ado, I'd like to pass the floor to our excellent moderator, Inigo Palacio Prada, who is, among others, he's a member of the IPECA Executive Committee. Inigo works with Repsol, where he is responsible for sustainability strategy and coordination, and he is very much passionate about sustainable finance. So Inigo, the floor is yours.
Thank you very much. Thank you, everybody, for attending this webinar. Hello from Madrid. Thanks, IPECA and IOGP for organizing these webinars. It's an honor for me to be moderating this, and I hope it will be interesting for all of you. Economic development happens when there is the right combination of regulations, technology, and social trends. Regardless of the scenario that we choose, finance is always critical, as we all need to borrow in order to invest in development. Almost nothing can be done just with own resources. Money has to come from somewhere in exchange of shares, dividends, or interest rates, and the oil and gas industry is not at all an exception for that. Investors and financial institutions no longer demand just profitability to their investments or lending, they also demand sustainability. ESG, environmental, social, and governance, is becoming mainstream. Sustainable finance is the name we give to all the initiatives under development to assure that money flows to the most sustainable projects, businesses, or companies. And you know that this topic has been heard so many times, and we can see in the next slides that I think that this is the one that I would like to show. You can see in this slide how this topic is being discussed throughout the world. Of course, maybe it's today more a European topic rather than worldwide topic, but it's interesting to see how this works. And if we go to the next slide, we can see that also the trend is increasing year after year. So this is something that is becoming much more than a trend. A net zero emission society in 2050 is a huge ambition, and the path is going to be very difficult. We have to go from 33 gigaton of CO2 emissions down to net zero in 30 years. While we meet all the energy demand that we need for economic growth. Fossil fuels are part of the equation, as we still don't know how to work without it. So every CO2, every ton counts from today until 2050 from any source. If we take a look at International Energy Agency documents, we can see that oil and gas is expected to have a big share on the energy cake in 2040. And even in the most sustainable scenarios, we have this situation with transport demand being and going to be very oil dependent, with billions that are going still to be needed for investing and to finance oil and gas capex and opex, and with this threat of having a supply shortage in case of lack of investments. So given all this, the big question that we can raise today in this webinar is the following. How can the oil and gas industry and the financial institutions work together sustainably through the energy transition towards net zero emissions, fulfilling both energy demand needs and environmental commitments? I will open the floor to our very, very interesting and very well-known panelists of today. And I will start with the first panelist, which is Myla Craig, Canadian, founder and president of Milani Included, which is an independent advisory firm that helps investors to integrate ESG issues. Myla has huge knowledge and expertise in sustainability and finance. And apart from other things, she is co-chairing the steering committee of the Finance and Sustainability Initiative of Finance Montreal. Dear Myla, thanks for being with us today. I will give you the floor in a second so you can try to answer these quick questions that I raise now to you during the following 7 minutes. The Canadian government approach towards sustainable finance seems to be very interesting for our industry, as it includes a specific recommendation, number 12, that says, and I quote, support Canada's oil and natural gas industry in building a low emissions, globally competitive future. I would like to know and that you share with us your opinion about this Canadian approach, and also to know how you foresee the role of oil and gas in the energy transition and the influence of sustainable finance on it. And finally, how do you think the oil and gas industry can improve its ESG performance and disclosure? So having said that, please welcome Myla. The floor is yours.
Thank you very much, Nico. And I hope I can answer all of those questions in 7 minutes, but if not, I'll certainly take them in the Q&A. So thank you. It's a pleasure to be here, and it's a real pleasure to be able to offer some view of what's happening here in Canada. And just first and foremost, and I think you've touched on this, we're very unique in the fact that we work with investors. We've been working with investors for well over 12 years, helping them integrate ESG into their processes. And we work with public companies, helping them articulate their financially material ESG issues. So in that, we're often talking to their financial stakeholders as well. And I think that's probably the first message that I'd like to bring forward is that when we're talking about sustainable finance, we're talking about something broader than investors now. That it really now does include your banks, your insurance company, the credit rating agencies. So it really is all about getting access to or the price that you now need to pay for capital. And so to start, I thought I would just give you a bit of context here about Canada. And of course, most of you, when you think about Canada, you think hockey, beer, or maple syrup, and all three of those would be very accurate. But we have some other strengths as well. We are a very well respected for our financial system, and we do have a very concentrated financial system within our banks, insurance, and pension funds. So it is a real benefit that we're able to be more agile. And in fact, 75% of the assets in Canada are actually managed by 5 of our largest pension funds. We are large, second largest country in the world as far as area, GDP ranked number 10th in the world. But we're also the 4th largest oil and natural gas producer in the world, and we have the 3rd largest oil reserve globally. But we also have some significant challenges, as you've mentioned. We are a highly dependent carbon economy, and our largest exports are oil and gas. They are 2/3 larger than the next sector, which are actually autos, and about 65% are larger than other resources. So we are the 2nd highest GHG emitter per capita in the G7. And according to the IPCC, Canada is warming at double the rate of the rest of the globe. So these are all major issues that are somewhat out of control. We also, though, have a federated regulatory system, which means that it's not easy to get decisions made for the whole country at once, which leads to perceptions of regulatory uncertainty as well. And one of the other unique things about Canada is that versus other jurisdictions of oil and gas producers, many of our energy companies are actually publicly listed. And so therefore they are targeted for divestment and much greater pressure for disclosures and transparency. And there's a number there about some of the stats that we're seeing about some of that divestment of funds. So in Canada, the issue of markets shifting focus through sustainable finance towards issues like climate change, it's not the only issue, but it's the biggest one right now. It has a long-term, huge impact on the viability of our economy. And the result is that capital is actually flowing out of Canada. We're seeing lots of public debate about production, exploration, and market access. And then, of course, we've seen price deflation. So all of that, it's like we've got the perfect storm happening. And it is, it's well recognized here in Canada that we need to invest in adaptation and transitioning our economy, and that finance will not solve climate change. But the things that will be required to deal with it will require significant investment, as you mentioned. And this is where the financial sector is critical. So in 2018, our federal government funded the Canada's Expert Panel on Sustainable Finance that was tabled just over a year ago in June 2019. The report itself has 3 pillars with 15 recommendations, 15 major recommendations, many sub. The first one is addressing the shift that Canada needs to make in our conversation from this being a burden to it being an opportunity for Canada, and really creating a vision and a capital plan so that we can be competitive. The second outlines the blocks for maintaining or for mainstream engagement. And that's really about developing reliable data and disclosure, getting some legal clarity and supportive professional services. And I highlight here just one of the recommendations is about clarification of fiduciary duties, both for investors and boards of directors. And that's something we're starting to hear a lot of noise about here in Canada. And then the third, as you mentioned, is about developing and scaling market structures. And that includes making sustainable finance business as usual, as well as specific recommendations to support Canada's oil and gas industry in building out a low emissions, globally competitive future for our country. So you might ask what's happened since, and as you can see on this slide, quite a bit, and I'm not going to hit them all because there's a lot happening. But one of the biggest and most important elements is that we actually had a general election shortly afterwards, so last October, and we ended up with a minority Liberal government. Since then, we've seen 17 of our 37 cabinet ministers receive mandate letters that include putting Canada on a trajectory towards a net zero emissions by 2050. We've had a House of Commons Standing Committee recommend that we adopt these recommendations of the expert panel and fully fund it. We've had the Bank of Canada coming out with reports talking about climate change as the most significant risk to our financial systems. Our finance minister has said that it will be part of the budget. It was supposed to be out in March. Obviously, with COVID, that's been delayed. One of the biggest pieces, though, I will highlight is that we have a new governor of the Bank of Canada, who was actually one of the 4 members of Canada's expert panel on sustainable finance. And one of the first comments coming out from him was that once we pass the COVID crisis, that the bank will be focusing on how climate change can reshape our economy, our productivity, spending, and ultimately prices. We have 2 other major reports coming out before the end of the summer. One is this task force on resilient recovery, and the other, though, is a Canadian taxonomy, similar to what we've seen out of Europe. But one that will really, the goal is to put Canada in a place where we can actively lead and define what qualifies as transition activities in Canada. And it will be different than what we've seen in other jurisdictions. And so my last slide is just then, what does that mean? And where does that leave the investor community, and where does it leave issuers? So we did a quick study in April. We did a study of our Canadian institutional investors on their views after COVID-19 hit. And it's on our website if anyone's interested, and I'm happy to take questions. But what it highlighted was that 74% of those institutional investors in Canada actually felt that the pandemic has raised the profile and the interest of ESG and sustainable finance. And 2, that 87% of them expect that climate change will remain a key theme in 2020 and beyond, because we were getting questions about whether the pandemic meant that you didn't have to worry about this. So the last thing is, some of the themes that we're seeing from these financial stakeholders is the investor community is moving away from third-party rating agencies and really moving towards their own proprietary valuation models, which I'm sure Ben will talk more to. On disclosure, we're hearing that investors would prefer ESG-focused reports versus the 100-page sustainability reports, with a strong focus on the Sustainable Accounting Standards Board and the Task Force for Climate-Related Financial Disclosures frameworks. Investors are expecting to see Canadian energy companies outline a transition pathway, meaning to describe what you've done as far as planning, what your scenario analysis results are, and that you disclose this, acknowledging that the process will be progressive and that you may not know all the answers and that you may need to change things mid-course. And maybe a big point I'd like to make is that not all investors want to divest. We've seen a significant shift in the responsible investment community towards a recognition that it is actually really hard to divest completely away from fossil fuels. And there is a large portion of investors that are actually looking at how and which organizations will survive the transition to a low carbon economy. And so what they really want is to be able to engage in a conversation with you. They want you to be able to describe what this transition means to your business. What's your plan? What should they expect from you? And for us, that all leads to, an organization's ability to either get access to capital or what the cost of the capital is that you will need to pay in order to continue to do what you do. And I'm going to stop there, and I'm happy to take questions in the Q&A if that makes sense.
Thank you very much, Myla. Very interesting conversation with you, and I hope we will have time to discuss in the Q&A part of the webinar. Now I'm going to introduce you to the next panelist. Ben Yeo is Senior Portfolio Manager of Global Equities at the Royal Bank of Canada Global Asset Management. And he is also a member of the UK's Financial Reporting Council, Investor Advisory Group, and the International Accounting Standards Board. I ask people to mute because we can be listening to other conversations, please. Sorry for this interruption. Dear Ben, thank you very much for being with us today. And I also raise some questions that can open you the floor for your 7-minute presentation. How does RBC Global Asset Management use the concept of sustainable finance when you make investments, and how sustainable finance has evolved within your company? Is there a space for oil and gas industry in the context of sustainable finance? And finally, how does ESG principles fit with sustainable finance? So thank you very much, Ben. The floor is yours.
Sure, great. I'll try and answer those questions. Each one of those could probably take 7 minutes each, so I'll try and wrap them all in. And thanks, Myla, for providing the background. Myla mentioned one thing quite interestingly at the beginning about how companies are now having to address a lot of stakeholders, and there's a lot of talk about inclusive or stakeholder capitalism. I'm going to mainly talk about the investor point of view. I, along with my team, manage about $13 billion in global equities, and we have a deeply integrated, what we'd call now ESG type of process. But I don't represent all investors. Obviously, there's equity, there's debt, there's lots of these things. But for a lot of investors, the focus on stakeholders is interesting because we're often interested in stakeholders because they're important to a company. So in and themselves, they're also important to shareholders. So, you know, your relationship with your regulators, your relationship with your customers and suppliers all become really important because that's important for your business and will be important for your long-term cash flows. So there's perhaps less of a difference than there might seem. One of the other reasons that we're really interested in a sort of deeply integrated ESG approach is that another term for ESG or a lot of these things is thinking about these as extra financial business factors or intangible factors. And there's a lot of evidence today that many of these intangible or ESG extra finance factors, as you can see on this slide 13, are hidden from accounts. They're hidden on the macro basis because GDP, as in terms of national accounting, doesn't include many forms of intangibles. And most economists will agree that the wealth of a nation is not accounted for completely in GDP. You've got intellectual capital, human capital, natural capital, which is very important to this industry, which really isn't accounted for. But it's also true on the sense of company accounts. So your accounts, particularly in energy, you might have some sense of where you might have some energy assets, again, accounted for, not accounted for. We've obviously seen some write-downs in the last few months by certain companies. But it seems to be that the relevance of those accounting metrics to where the real value is the lowest it's ever been. And this is the idea that a lot of extra financial value, either positive in the terms of an asset or what an accountant might call an off-balance sheet contingent asset or an ESG or sustainable asset, or a sustainable or ESG liability, simply not accounted for in accounts. And this has two interesting effects if you believe that theory. One is that it's a source of market inefficiency, because if the information about it is not so great, then there's a market inefficiency. And that means active managers or even sophisticated quant managers should be able to take advantage of that inefficiency and produce better returns. So that's a really important aspect of this, as well as the fact that our own stakeholders are asking us to engage in these matters more and more. So if you think of that as an argument for the flow of how sustainable finance or ESG has evolved and where we're thinking about it, traditionally, you kind of want your share price to go up over the long term. That's the middle. And when you own shares, this is where you should practice stewardship and be owned, active, engaged owner. Typically, we have thought that shares go up and down depending on how well you manage things like your cash flow, your margins, and your sales, right? So strong cash flows into the future, eventually your share price goes up. And a lot of traditional financial analysis has been based around that balance sheet, cash flow, income statement analysis. But there's now two issues with that today. One is a lot of that is commoditized. The quant machines can do it very well. Second is it's backward looking and all of that. So you then got to think, what is it which drives sales and cash flows in the future? Well, those are aspects of business performance, and a lot of those you could put under the rubric of extra financial, ESG, or intangible. That's your corporate culture, your governance, your incentives, your R&D, your relationship, your regulators, your customers, how you look after the environment, and all of these type of things. And that is the flow of causality here. We're looking at integrated ESG because if you manage these business aspects well, you're going to lead to better future long-term value. And if you manage them badly, you're going to destroy value over the long term because they lead to better or more destructive aspects on your cash flow. So I'm going to skip ahead. And so one of the ways of thinking about this is that you've got extra financial forms of capital. You've got capital, natural capital, you've got capital, human capital, intellectual capital, and all of these type of things. And one of the difficulties that not everything that counts can be counted or easily counted, like your corporate culture, like your incentive scheme. And the problem is that due to either incentives or the way of your business model or things, the problem is you can over borrow from one of these other sources of capital really easily. So you can borrow from the environment by not cleaning up after yourself, and you get hit with fines when you have environmental damage. You can borrow from your customers by cutting customer service. You can borrow from the future by not investing in R&D or investing in R&D in the wrong projects. Or you can borrow from your employees by cutting salaries, cutting training and development. And as you can see, if you borrow from your employees in that sense by, say, cutting training and development from your employees, then all your best employees over the long term will likely leave you to go and work for other firms, and they'll leave a review for you on Glassdoor which says, don't work for this company. So what you would have done by a short-term impact is actually really impacted your long-term value creation. Well, if that's true on the downside for your contingent liabilities or your negative or weak ESG business practices, it's true for the positive. So you invest in your people, you invest in R&D. That might cost you more near-term cash flow, but you're creating a stronger return and a stronger asset in the future. And that would be the opportunity side of ESG, which I think is really valuable and is underappreciated. Mila referred to this. We're trusting less and less the default ESG rating. And that is, as you can see, these are the 2 or 3 big ESG rating houses. This is from a Wall Street Journal article a couple of years ago. And you can see there is big disagreement. And that is because ESG by a rating agency is not like a credit rating, but is much more like a sell-side broker report. So it shouldn't be treated as settled facts, but is worthwhile analysis, which you should then derive further research in. Just because broker X says sell on a company, no portfolio manager automatically sells or automatically buys. You need to understand what are the assumptions which are going on behind that to get a view on where the company should be. So putting that all together, just kind of summarizing that, is our focus here is on long-term value creation. And as Warren Buffett said, someone is sitting in the shade today because someone planted a tree a long time ago. Investing in a lot of these ESG assets should create long-term value, and skimping on a lot of these things will actually destroy value over the long term. Happy to take any questions in chat.
Perfect, Ben. Thank you very much. I really appreciate this sentence from Warren Buffett regarding the shadow of the tree, because we are here at 38 degrees Celsius in Madrid. Okay, now we pass to the next panelist. Let me introduce you to Yo Takatsuki. He is the head of ESG research and active ownership at AXA Investment Managers. And he is currently co-chairing the Climate Transition Finance Working Group by the ICMA. Dear Joe, thanks for being with us today. And let me put some questions on the floor previous to your presentation. How does AXA use the concept of sustainable finance? How are AXA's transition bonds? How do they fit with oil and gas projects? And how do you foresee their evolution? Do you think that they will have a clear definition and principles, or will they just be a generalistic qualification of everything not green? And finally, regarding sustainability-linked bonds, how do you think they will evolve and they will coexist with other kinds of bonds? And what kind of market distortions can happen or can we expect in case of divergences in the accomplishment of the sustainability targets behind this kind of bonds? Thank you very much, Joe. The floor is yours.
Thank you very much. And I also just wanted to highlight that the points made by Myla and Ben before me, these are actually a lot of sentiment and analysis that we also share at AXA investment managers. And some of those questions I'll try and tackle. I'm not sure if I can answer quite all of them, so apologies in advance to those who kindly put them forward. Just literally 20 seconds. I think the key point to note is that AXA investment managers have been doing sustainable investing in some kind for quite a long time, best part of 2 decades. It's not a new conviction. It's something that we believe to be relevant for all of our investing activities, whether it's in equities or corporate bonds or within the alternative space. The big change has been that over the past 20 years, the team has grown. The breadth of activities that we're involved in, from research to developing quant tools, through to active ownership, so engagement and voting, and the public policy work we do, and also just a broader interest from clients and also the company's understanding of it has really meant that this has become a very colorful and interesting part of the financial industry to work in. And it's also one where we've committed a lot of resources to. So thus, currently, we have about 30 people working full-time on ESG within our firm across the world. So we basically have a few football teams worth of ESG people doing various different roles within our business. I wanted to just spend a few minutes just going through actually what our kind of building blocks are. And I think Ben gave a very good explanation of the rationale and the reasoning behind why and how investors should approach this. But from a more kind of a concrete way, the way we've been going about it is that we really have 5 key building blocks. So first of them is probably the longest running one, but also the one that is kind of becoming something that's a little bit more on the sidelines. It used to be the main approach to sustainable investment. I don't think it really is the case anymore. It's about avoiding. So AXA IM has a handful of exclusion policies within the firm that's applied not just to the SRI funds, but across our mainstream investment products. I think that's quite a differentiating factor. So roughly or around about 550 billion in listed to corporate bonds, sovereign bonds, and equities that we manage. We apply these rules pretty much for 9% of our funds and mandates. These include an exclusion policy from coal. The threshold is 30% energy use or 30% revenue for coal miners. We also have a ban list for tar sands, but beyond that, fossil fuels we do invest in. We obviously then look further into what the underlying business case is. So we have identifying, we have analysts working both from a bottom-up stock perspective, quant tools, and also kind of more macro and thematic perspective, looking at the balance between risks and opportunities in the long term. And then obviously the portfolio managers themselves who have at hand the front office tools that allow them to make the investment decisions. So the key point is that a lot of this information is literally at the fingertips of our fund managers when they make the decision to buy or sell a bond or a share. The fourth part is something that's emerging more and more. A lot of our clients and also our parent entity want to know about how their investment can have positive outcomes. So these are often being encapsulated within the Paris Agreement or the United Nations Sustainable Development Goals. And then the final bit, which is a very important part, is what happens after the investment is made, which is this concept of influencing. We're large financial institutions. We can play a role in driving better practices within the various industries in which invested in. So that happens through our engagement, or our voting, or our public policy work. But also, sometimes we work to change the underlying market structure as well. So there's an aspect of the Climate Transition Finance Working Group, which we co-lead. That's actually about how the money can flow better from those who can invest to those who need to borrow in the capital markets to make sure that the best climate-related outcomes can be achieved. I'll go into a little bit more detail on that in a second. This is a case study. So this is our parent entity, and we manage their insurance balance sheet investments, which is a few $100 billion. And they have taken really quite a large step over the last few years into essentially big public commitments around sustainability. And these are listed here. So, we've excluded the darkest brown fossil fuel intensive assets, so coal and tar sands, and some of that is then being reallocated to the deepest green. So currently we have a goal to have 24 billion euros on behalf of our parent entity in a green investment plan in the next 3 years. That includes green and transition bonds alongside some alternatives like property. We obviously conduct ESG and setting KPIs and forward-looking targets about carbon intensity. We have obviously engagement activity, and they also invest in impact investment funds where the main remit is to try and allocate it to clean energy or energy efficiency or those types of projects, which is really moving the needle. So it's not just a positive outcome, but the status quo is shifting as a result of the investments, the products and services. That's a kind of a niche area that our parent entity has invested in. They're not the only asset owner who's our client who's approaching their investments in this way. This is just a case study, but we see it from our clients all over the world now, not just in Europe, but in North America, Japan, Australia, and even in emerging markets where pension funds and insurance companies are increasingly wanting to take quite a comprehensive approach to tackling sustainability and aligning their purpose as an asset owner with the outcomes that's being seen in their investment. So this is something that's built, and it really goes to show that actually this sustainability thing actually isn't really a fad, and some of the commitments mean that it's really here to set. Look, one aspect of our parent entity has been to invest in green bonds. We currently have about 6 billion euros invested in green bonds, and we're going to double that over the next 2 to 3 years. And as you know, green bond is really investing money into use of proceeds which are essentially renewable energy or energy efficiency or clean transport. They're the main areas of investment. I think everyone who's within this audience will probably know, if we're really serious about achieving the Paris Agreement goals, which essentially requires the society to cap global warming to 1.5 degrees pre-industrialization, that is going to require some pretty major step change from not just the green actors in our society, but from everybody. So that includes all industries. And this concept of climate transition has been developing, especially gained traction over the last few years, which is really to say, how can the world economy, which has largely been dependent on fossil fuels, we've built up over since the Second World War, has brought us a lot of prosperity, but we also have to accept that has come with some environmental costs as well. And for us as an investor, our view is that we can play a powerful partnering and enabling role with those, what I'd call the real world economy sectors, not just energy, but manufacturing, steel, real estate, transportation, cement, the list goes on, where there's a huge capital need between now and 2030 to halve the carbon intensity of their manufacturing or of their products and services. So scopes 1, 2, and 3 is the jargon that we use. One of the ideas that we've pitched, it was a call to action that we published last year, was to say, look, alongside green bonds, why don't we potentially create a separate class called transition bonds? But really, these are aimed at fossil fuel dependent industries but the technology doesn't exist or the manufacturing process doesn't exist to make the full step jump into green today, but they clearly have an urgent need to go on that pathway to take the carbon emissions out of their business over time. And so that idea has had a lot of reaction, a lot of interest. And so we launched a working group through the Green Bond Principles at the beginning of the year. We're one of the co-chairs alongside HSBC and JP Morgan. And currently there are 80 capital markets participants in the working group. So it's an absolute monster of a working group with a lot of corporate issuers, including those from the oil and gas sector as well. Where we are at, and this kind of ties in with what Myla was saying through the Canadian work, and many of the Canadian banks are participants in the working group, and is that really the focus needs to shift away from just the use of proceeds underlying projects, which is what green bonds do, to looking more at the issuer level strategy and commitments. And how can they then be kind of described and provided at the moment of capital markets transactions. And I think that's what climate transition finance is really tackling at. Ultimately, it's kind of agnostic of the underlying security. It could be use of proceeds bonds. It could be a target-linked or KPI-linked bonds, such as the NL1, or any other number of asset classes, including secondary market equity issuances, etc., etc. The key point is what do corporate issuers need to provide to investors like myself at the point where they're doing decarbonisation financing to the capital markets. The four key building blocks of what Myla was saying is it's important for issuers to have a clear long-term strategy. If you don't tell us what you're transitioning to, what is the purpose of your transition financing? I think where there's been a relatively universal agreement is that that goal really has to be tied in with achieving the Paris Agreement goals. The second one is there's various disclosure programs and infrastructure and frameworks available. We're saying, is TCFD the main one? Is that the one where we should be expecting issuers to provide information around? But the key thing is are all issuers, small and in emerging markets, are able to do so today? And what is the capacity building that we need to do to enable that over time? The third one is by far the hardest, I think, because there's a lot of question marks about how that should be being done and what the assumptions about future technology development is about this concept of 1.5 degree Celsius alignment. So you can have a goal in 2050 to be a net zero company, but you could just choose to have all your decarbonisation efforts between 2045 and 2050. And as you can probably see, just in your mind, that doesn't necessarily result in you having contributed to a 1.5 degrees Celsius alignment. Just so you guys know, we do a lot of these types of scenario forecasting experiments and testing on our portfolios. And the best way to put it is that whether it's our equity or our corporate bond portfolio, it's currently headed to a kind of future temperature of 3.3 degrees. So a lot more than 1.5 degrees. And most of that has been taken through divesting from coal and shifting it into green. But we know that if we want to take it from 3.3 down to 1.5, it's the middle part of our portfolio, i.e. the bits that we're largely invested in, that has to significantly reduce in temperature as well. So that's why transition financing and this concept of aligning with the 1.5 degree future is so important. And then obviously the final bit, which is I think goes back to the question mark about target-linked bonds or use of proceeds bonds. What's the best way to do it? My view is that climate transition finance should be about what the issuer's goal is, but then how they actually conduct the transaction within the capital market should be largely to the needs, specific needs of the issuer. And every business model is different. Some are very capital intensive and use of proceeds might be more useful. Others, might have a different kind of business structure, especially in like services or, in certain different types of industries where, a target-linked model might work better for them. I think what we're trying to say is that taking away from this exact fixed income or capital market structure that you're looking at, the most important thing are these common languages about what you are doing at the corporate level. Now, just to wrap up, the working group is been around for 7 months now, and we are putting together our kind of findings and key thoughts at this moment right now, working with the working group to do that. So, hopefully in the second half of the year, we'll be able to provide you with a progress update. And I'm very happy to come and talk about that at that time, should we do so. Thank you.
Thank you very much, Joe. Very interesting. Let's go for the fourth panelist. Anibor Kraga is currently the Executive Secretary of the African Refiners and Distributors Association, which is the first ever Pan-American organization in the downstream business in Africa. Prior to this, he was Chief Operating Officer for the Refineries and Petrochemicals Directorate of the Nigerian National Petroleum Corporation, as well as having various roles in ExxonMobil upstream Africa. Dear Anibor, thanks for being with us today. And just a couple of questions before you start. What are the finance challenges that our industry faces in the developing countries and developing regions? How can the industry take advantage of the sustainable finance products? And finally, what does Africa need to make sustainable finance become an opportunity and not a threat? Thank you very much, Anibor. The floor is yours.
Thank you very much, Inigo, and good afternoon to everyone. I'm happy I'm actually going last because I've had a chance to see where the potential pools of financing can come from for Africa, and that's kind of what I'm going to focus on today. Most of the discussion around sustainable financing is focused on UN SDG number 7, which is clean and affordable energy for all. I'm going to try and balance that by also focusing on SDG number 9, which is industry, innovation, and infrastructure. How do we build infrastructure and ensure sustainable industrial transitions? First of all, I want to quickly take like 1 or 2 minutes to talk about the ARA. It's the African Refiners and Distributors Association. The name was changed in 2017 to reflect the entire downstream value chain, not just refineries. And our goal is to serve as Africa's clear leader in the transition to cleaner fuels. We promote exchange of best practices amongst all our stakeholders, and our focus on championing sustainable investments across the African downstream, as well as Africa energy security. So this is what we like to call our case for action slide. The IEA Africa Energy Outlook report of 2019 clearly stated that 1 in 2 people who are born between now and 2040 will be African. What that means is that our population is going to grow, and of course there's going to be a massive increase in energy demand. That would of course translate to a lot of pollution from the increased population. You can see from the chart on the bottom left that we're going to have a significant number of cities with huge populations. As a result, while we clearly align with the global view of moving to cleaner energy, we need a sustainable transition to ensure that while we're doing that, we do not have any public health disasters. In summary, we need targeted funding to ensure that we can upgrade our refineries and infrastructure to produce and transport these cleaner fuels. So let's talk a little bit about challenges and opportunities that we have. As of right now, Africa is focused mainly on industrialization. We have socioeconomic issues we're trying to address, and we're actually trying to get our current fuels that we're producing in line with global standards, which are 10 parts per million for sulfur or less. Currently in Africa, it ranges, some countries have complied, like in East Africa, but it ranges anywhere from 1,000 ppm and above in various countries. So the current definition for sustainable finance can actually limit the financial support that we will get for clean fuel projects because it's tied strictly to climate change policies. Another challenge is that accessing these clean transport fuels will be limited because we need infrastructure to do that. We need to put in place pipelines and and we need to upgrade our refineries. So these are the challenges, but what are the opportunities that we have? First and foremost, we need to harmonize our clean specs across Africa. I'll talk a little bit about that in a bit. And ensure that we have new distribution infrastructure to actively and aggressively propagate adoption of these cleaner fuels across the continent. And this will also allow sustainable frameworks to be put in place such that investments can actually be deployed as envisioned. Way forward, I think we need a 2-step approach to this. First and foremost, we need to make sure we have targeted financing to enable this transition to cleaner fuels, to meet the projected demand that we have and address public health concerns that are looming. Then I believe we can mandate ESG obligations into cleaner fuels transition funding that will enable us to unlock the required sustainable funding to address the climate change issues. A key initiative I'd like to spend a few minutes on is the adoption of the ARA AfriFuels policy. And this is focused on cleaner air for Africa, making sure we have better air quality for all African citizens. And the ARA is currently working with the African Union on adoption of these harmonized fuel specs across Africa. We're actually presently running a 3-session consultative forum with a diverse group of stakeholders across the continent. The first one we held on June 12th. The second one we're holding on Monday, and the third one will be at the end of the month. And the goal is to actually put a report in front of the technical committee of the African Energy Ministers in October before going to the broader assembly for adoption. And the target, like I mentioned, is Pan-African standards. We're looking to implement what we call AFRI6 specs by 2030, and that is 10 parts per million sulfur across the continent. The policies that we're pushing cover both health and socioeconomic issues, but a critical success factor for this, of course, will be securing the funding needed to upgrade the refineries to produce these cleaner fuels and meet the growing demand that is projected. In fact, as I believe the IEA outlook for Africa 2019 actually projects that Africa will be second only to India in the use of oil between now and 2040. It even has more demand than China for that. So we actually need to figure out how we're going to upgrade our refineries to ensure we have cleaner fuels. I'd like to point out that the policy focuses not just on cleaner fuels, but we're also pushing for cleaner vehicles as well. We need a framework that encompasses both, because without having clean fuels and clean vehicles, we will not get the optimum cleaner energy targets that we've set for ourselves. Oops.
Excuse me, Anibor? I don't know if you have really finished or there's something that has cut suddenly. I cannot hear you.
Hello?
Are you back again?
Yes, can you hear me?
Yes, I think so. Welcome back.
Okay. Thank you very much. I think, luckily, that happened just on the last slide, so I think I'm good. I just had some key takeaways, and key takeaways are as follows. It's not letting me show the slide. Can you see it? Hello?
Yes,
Hello?
we can see the slides.
Okay, good. All right. So,
Yeah,
in summary,
key takeaways.
no problem. In summary, Africa's projected demand of petroleum products is growing, and we need a transition to cleaner fuels to ensure that we have any public health or socioeconomic issues. Really and truly, Africa needs to create its own vision for accelerated economic and industrial development. That's what we need to do. And the current initiatives for sustainable finance focus primarily on climate change, and they don't really consider the financial requirements for the transition as envisioned in Africa. Right now, the African Refiners and Distribution Association is working with the African Union to adopt harmonized clean fuel specs across Africa. A critical success factor for doing this will be securing the required funding to do so. Again, we're looking at a framework that covers not just cleaner fuels, but cleaner energy, cleaner vehicles as well, to get cleaner air. And finally, we need targeted pools of funding or financing to make sure that we can upgrade our refineries and infrastructure to enable a sustainable transition to cleaner fuels across the continent. Thank you very much, and I'll take any questions at this time. Thank you. Over to you.
Thank you very much. Thank you very much, Anibor. Very interesting. Well, I have bad news. We have only 4 minutes and we have more than 20 questions. So it is going to be impossible for us to answer all of them. I have tried to make a small selection, so I will pass very quickly through these selected questions, and I would kindly ask the panelists to be telegraphic in the answer, okay? First question is for Anibor. How can we integrate ESG criteria when thinking about building a refinery project in Africa?
Thanks, Inigo. Very quickly, ESG criteria is already implemented in projects. When I was at ExxonMobil, we raised funding for drilling financing, and Equator principles are already in all project financing documents that are for projects that are executed. So all we have to do is, in the downstream, is the same thing: ensure that Equator principles are put in the standard project documentation. I hope that answers that.
Thank you very much. I have another one for you. Do your transition bonds recognize oil and gas companies really actively investing in the decarbonization?
Sorry, you broke up there.
Do you want me to repeat
the question? You broke up.
Yes, of course.
Yes,
do
please.
your transition bonds recognize oil and gas companies that are actively investing in decarbonization?
So I think the question is that I am not going to comment on any specific sector. Important is whether you're an oil and gas company or you work in cement or you're a cruise liner, there are key information and commitments that you really need to be thinking about making. Now, some of these commitments are being done by the oil and gas industry, especially European oil majors have announced quite a few of these over the past few months. And so that's notable. And then, the question that I would ask is, well, having had this long-term strategy and you've made some interim targets that you want to hit in the meantime, what is the expenditure that you need to do to enable the success of this strategy? Where are you having to invest in? Or maybe it's about scrapping existing business lines. Do you have to retrain employees? There's various costs actually implemented with achieving the climate transition. I think what we're saying is be transparent to us as investors about what it is that you need the money for. So no sector is out of scope, but I think what is clear is more about the intentionality of the issuer and then the credibility of their plans to actually get this done. That's how I would describe it.
Thank you very much. Myla, one for you, please. From a point of view from Canada, do you think that the EU is really becoming the mainstream way to approach sustainable finance? Is it the model to follow in the rest of the world?
Well, I think that there's maybe an argument that we're inspired by it. Obviously the Canadian economy is very different than the EU economy with respect to the carbon intensity, et cetera. So I think Canada is being inspired by the EU, but I'm not sure it is the only approach, because we have to create our own unique approach to this, given the impact that it will have for our economy. And I would suspect that maybe other places like Australia and other places where it's very resource intensive, that they may need to do something a little bit different as well.
Thank you very much. And one for Ben. What's the biggest difficulty when we try to identify the ESG impacts when thinking about a sustainable investment?
Sure. I see there are a lot of questions as well. So if you need to get hold of me, do message me through LinkedIn. I will take only LinkedIn requests if you had any further questions. So the difficulty on this is this concept of materiality. So here is this notion that also, say, investors and accountants might take different ideas on what is material. What is a material to negative or positive long-term cash flows? And then the second issue or difficulty is, even if we identify something like which is material, say culture, incentives, human capital, or even carbon scope 3, there can be a lot of difficulties in then measuring it or assessing it in a way that a lot of reasonable people can disagree on. So first of all is actually identifying the material aspects to long-term cash flow, both positive and negative, and then putting a number to it or putting it into analysis for where you can do so.
Thank you very much, Ben. Well, the organizers are telling us that we can stay here for 10 minutes. It's for free, so I think that we should be making profit of it. And I can keep on going with some more questions. Myla, again, one for you. You were talking about ESG reporting against sustainability reporting. Can you dig a little bit further on that?
Yeah, so I mean, what we're definitely seeing is a desire for a much more concrete approach to these ESG financially material issues. So as we know, a sustainability report typically speaks to all of the organization's stakeholders, employees, the communities, et cetera. And it's important, and there is a reason for that sort of communication. But what we are seeing is as there is this development with your financial stakeholders, again, your insurance, your banks, your investors, credit rating agencies, that there really is a growing need for an ESG report. So really honing in on what are those financially material issues, as Ben referred to. Typically, when we do this work, it's 6 to 8 of them, and really diving into those 6 to 8 and communicating very clearly about what your strategy is on those issues. And you're starting to see that in Canada, that we are actually starting to see some of our issuers creating an ESG report versus a sustainability report, and how they're putting that and distributing it out into the markets. The strategy is being developed a little bit differently than what we've seen in the past.
Thank you. Another good one for everybody. Imagine that all investors start to focus on 1.5 degrees portfolio. How can this be managed? To what extent is this going to be too much cumulative? Or saying it the other way, do we have the risk of having more money than projects if we all want to go really green at the same time?
Maybe I'll just start on that. I mean, I think from our perspective in Canada is that it really is about a transition. This isn't. It's not something that we can do overnight. It will take time, and I think that's the difference. I mean, I'm very curious to hear how Ben and Yo view that. But certainly, what we hear from the investors is that there's an acknowledgement that this will be progressive. I think that there's an interest in balancing portfolios, but I think there's also a recognition that we can't just walk away from the oil and gas sector completely either, because of the use of that resource into so many elements of our economy. And this is something that will take time. So therefore, it's more about a transition to a lower carbon economy versus an immediate shift overnight. I'll leave that up to Ben and Yo to respond as well.
Can you repeat the question again?
Well, the question is more or less to know how to cope with the market if we all go for only green investments and we focus too much, and maybe we can be collapsing the green investment part of the investment scenario, and we can be lacking projects to invest with these tools.
Okay, so that's a deceptively simple, but with a complicated question embedded within it. And a lot of reasonable people disagree about the exact ecosystem of this. But what I think is occurring is perhaps one way to understand this is the joke which is going around is using this term 50 shades. So there might be 50 shades of brown and 50 shades of green, from dark brown to light brown, light green to dark green. And what the market is trying to do, either through taxonomies or investment, is that within the transition, you want to go from darker brown to lighter green to darker green on a kind of spectrum. And also reasonable people might disagree about what being light green or not light green because of the ideas of scope 3 or circularity or or net carbon and ideas like this. But then the market will then allocate capital with those different pools of capital, both debt and equity, to where they will see, okay, this is going to be looking good, even though it's going from dark brown to say light brown, which might still be a brown sort of roll. We can see that this will be positive for carbon emissions, either scope 1, 2, or 3, some idea of why, well, that might be taxed or not taxed, and rolling that into that framework. Some investors may not want to be on the brown spectrum, may want to be on the green spectrum, may be working within that. And I think you'll find different pools of capital within that, seeking different returns across that, but with a lot of it geared to transitioning down those colors in the way that they can do the analysis, that they're satisfied that you're moving in the correct direction in any number of those projects. Now, taxonomies can help where they might identify some areas, although I think people will disagree on some of them, because you might classify something as say light brown, whereas you think, well, this is a dark brown to light brown project, and that will help. But I think that is where the market's going, with different associated returns and cost of capitals and different risk adjustments and policy scenarios on top of that thinking. So there's certainly going to be a place for green bond, dark green taxonomies, but there is definitely going to be a place for transition from dark brown to light brown. There's a place for primary finance, and also where that cost of capital will be either in debt or equity for that. I hope that just gives you a kind of flavor for some of that debate is, but it's by no means settled.
Thank you, Ben. Anibor, I don't know if you want to answer also this question that was raised for everybody, but I have also another one specifically for you. Do you think that the banks are going to be to find attractive when we invest in specific projects in the refineries to reduce our scope 1 and 2 emissions?
Okay, thank you very much. Let me start with the first question first. Let me answer that. For Africa, I think there will be 3 different types of projects, right? I think right now, Africa has the largest solar resources in the world, but we only have 1% of the installed capacity. So there will be investments in the actual solar projects and all of that. Secondly, there's going to be investment in transition. For example, the cement manufacturer who currently uses fuel oil needs to transition to solar. There'll be investments in that. And thirdly, there's going to be investments in the extractive industry to get the minerals for the batteries and all the other things. Africa is rich in all those resources. So I think there'll be a variety of projects across Africa seeking this green funding. Now, on the second question, which is let me just be sure I'm correct. Will banks actually fund projects in refineries for cleaner fuels? Is that basically what it is in a nutshell? Is that correct?
Yeah. Yes, this is the thing. Specific projects that we can be developing in a refinery to reduce scope 1 or 2 emissions, refinery or oil and gas asset anywhere, and to what extent this can be seen less or more attractive because of being a little bit stigmatized for not being able to fulfill all the green requirements.
Thank you very much. I think that question hits the nail on the head for why we need a 2-step approach for Africa's situation. We do, like I showed in my one of my slides, the population is growing a lot. And because of that, we need to have cleaner fuels as we transition to zero carbon emissions and all that. So I think as long as we engage properly and understand there's a 2-step approach, like I put in there should be some funding for that. Now, in terms of actual bank engagements, I spent about 2 years at NNPC engaging with community of traders and banks to try and raise funding to upgrade the refineries in NNPC. And the issue for the bank is, right? So if they will get a return, if the projects will get a return such that they can service the debt that they're giving, I don't think there'll be an issue. The issue will be more on stigmatization, which is why we need to have this 2-step approach clearly defined and clearly articulated with all stakeholders so we understand what the limits are for that. As long as the funding can come in place, as long as the projects can be done, as long as we can sell the fuels, which is why we're also going for harmonization of fuel specs so the market is all across Africa, not just a specific country. I think we should have projects that work for banks.
Thank you very much, Anibor. I think we have to stop here. It's 11 minutes past the timing we had scheduled. I hope it has been interesting for all of you. It has been indeed for me. And I want to thank all the organizers, the panelists, and of course, all the participants. I have seen the list and it's huge. Maybe more than 200 people were participating. We are recording this, so maybe everything is going to be available for you in some days. So, well, I would like to resume this webinar saying that sustainable finance is the place where sustainability or non-financial issues become financial, because this is really the link between these things that are not so financial with the money. Last seconds, just to remind you that we will have another interesting webinar in some days' time on July 16th, Thursday, I think. Focused on the new and already well-known EU taxonomy. I encourage you to participate on this second webinar regarding sustainable finance organized by IPICA and IOGP. Thank you again, everybody, and have a good day. Bye-bye.